to the Future Ventures podcast on Scaling with Clarity. Today, I'm joined by Dr. Nisha Kohli, founder and CEO of Corpstage. Nisha is a chartered accountant with a PhD in corporate governance and more than 2 decades of experience across finance, governance, and corporate strategy. Her work is built around a provocative idea. A company can appear compliant on paper and yet still lack the systems and resilience to withstand real-world pressure. Through Corpstage, she is working at the intersection of ESG, financial discipline, governance, data, and AI. Nisha, welcome to Scaling with Clarity.
Thank you very much, Maxim, for having me. Honored to be here. Yeah, looking forward to the conversation.
Me too. It's an area that is bubbling up to the surface all the time. This week alone, two of our clients are dealing with governance issues. In one case, they have a large group of 11 shareholders, and which 10 are board members, and then the other one is in a formation. So, like working through corporate governance, it's not simple, and so it's only through experience that you understand kind of like what are the things that you have to put in place versus the things that you can let go of. But this is it is foundational to the success of a company. So what interested you in corporate governance?
Yeah, very good question. Yes, I was actually asked. I come from finance background. I'm a chartered accountant. That's my first degree after undergrad. I did this CA, and then I got into academics, and that's where I was told to do to do PhD. And if I didn't do PhD, I wouldn't be allowed to teach, at those colleges. So I registered myself, and in that time, like 2005 is the time when I registered for my PhD, and that was the time when people were talking about corporate governance and CSR a lot. And investors have started integrating these into investment decisions. So a question came to my mind that how does this relate to valuation? And all the more I was intrigued by the qualitative aspects of corporate governance and CSR and how do you value those. So my PhD was around how do we quantify the corporate governance parameters and then connect that, or empirically connect and draw conclusions with the valuations. So does corporate governance actually impact valuations or not? So I studied 6 parameters around those, the principles laid down by ECD, and then I found that value creation parameter got the strongest significance. And that's where my whole work related to corporate governance, CSR, valuations, it started as consulting back in 2008 when I finished my PhD. Yeah.
And so I'm curious. I mean, you and I are both fellow chartered accountants, although in Canada I'm not allowed to call myself chartered accountant anymore. I'm a certified public accountant, I think it stands for. But what are the 6 parameters that you're referring to in terms of corporate governance? What is the causation, correlation, kind of like let's double click on the science behind kind of like what value does corporate governance drive?
Absolutely. So, OECD has laid down these 6 principles, and first of them is the board composition. So, is your board composed of, whether you have independent directors or not, and non-executive directors, how many, and then this second parameter is about the conduct of the board. How does the board meet? Do they meet 4 times a year? Do they have enough quorum? And in the composition, we also consider qualification and experience of the board members. So these two are related to the board. The third one is related to separation of CEO and board. That whether CEO is totally different role or capacity. And interesting research around that if the both roles, both like CEO and chairman of the board, they are combined, then it's faster for the company to take decisions. But in American systems or Anglo-Saxon theories, we see that shareholders are dispersed. It's better to have the roles separated. So then the fourth one is the concentration of shareholding. We see that, in particularly in the Asian context, we see that a lot of companies are promoter-based, founder-based, and they still hold more majority of the shareholding. But what happens is with that, minority shareholders, they get impacted, sometimes negatively. So when a company goes in for merger acquisition, they just have the majority, they get acquired or they get merged with some other company, and the minority shareholders have no say in that. And also, banks also sit on the boards of many companies in the Asian context again, where banks provide a lot of funding, loans. So they have a director in the board of directors, and they have a seat there. So in those cases, what happens is minority shareholders, we have to see whether their interests are ignored or, how are they taken care of. So proxy voting and how do we conduct AGM, those kind of things are covered under that particular aspect. And then it's about related shareholding, how does the company take decisions, whether there are conflicts of interest and those kind of things. And then the last one is the value creation aspect, whether you are considering all the stakeholders like creditors, suppliers, employees, communities. Are we considering interests of those as well? So according to my research, the value creation aspect was the strongest linkage between the company's valuation and the corporate governance. Yeah.
So if I understand correctly, with value creation, the more they focused on broad-based stakeholder consultation and identifying all of their stakeholders and focusing on value creation, the better the corporate governance is.
So the more you engage with stakeholders, you take care of the interests of the stakeholders, the company is better valued, because it's all about long-term resilience as well and long-term growth. Like if your stakeholders are not happy, or their value is not created, or they don't grow, then the company will have some kind of failure. Let's say, if a supplier's interests are ignored, the suppliers won't deal with you. And we saw that, if suppliers, let's say if we ignored the supply in COVID times, all the industries, all the companies around the world, they realize that their, all the manufacturing is located in China, and, so they did not diversify their operation. They did not diversify the supply chain. It was impacted a lot. So, in that case, company has to focus on the suppliers and customers. And likewise, you have to take care of the interests of all the stakeholders. And that's where ESG is connected as well. And it's like a natural stretch or extension of that value creation. It's a stakeholder theory. So that's a natural extension to ESG. And that's why I'm into this space of ESG today.
So I have a question around ESG. For two publicly traded companies in Canada, I was responsible for essentially preparing the ESG or CSR report and assurance. And back in, I want to say 2015, 16, 17, 18, ESG was flying high. And as of recently, it has taken a bit of a backstage. What's driving this? What's driving this direction? Why is ESG not as important, or at least it does not have the same level of resonance as it once did?
Yeah, it's basically there are two reasons I give this. One is the myth that ESG is a cost center, and we are just incurring costs. It's not giving any value. And second one is economic factors itself. When companies have priorities, different priorities, and it started with tariff situation around the world, where in 2025, early 2025, tariffs changed, and then actually before that, even Russia-Ukraine war led to inflation in Europe, and that's where some backlash started, and then Europe started saying that if other countries are not doing, why should we do at such a economic situation? So that, I mean, those things started, and then 2025 terror situation came, and then again the war situation amplified. So those kind of pressures really impacted ESG, and companies are today more focused on profitability. So when we go and reach out to our clients for the platform or for consulting, they say, how does ESG relate to profitability? What will I gain out of it? That's the first question. So we have to actually prove to them that these steps, or this ESG, what we call this ESG today, and back in 2008 I was saying the same thing as value creation. So if you do these, I mean, there are parameters again for ESG. If you do these, you will create value for the entire organization. So there's business value in it, and that's people don't understand. They consider it as a cost. That's why I say it's a myth that they think that it's a cost center. Why should I do it if it's a cost, right? So we have to educate. We have to amplify this, that it actually creates value, and the one is actually creates resilience. So you become stronger, as an organization, if you follow these. It's not just for compliance or just for reporting.
Nisha, which letter in the ESG drives the most value for companies?
Which part of ESG? Good question. So, given the current scenario or current situation, when we're talking about climate change and actually temperatures are increasing and supply chains are getting affected, it's E. But I would say, again, if G is not there in the organization, E and S both are ignored. They will not happen. So G is the most important thing. And forget about ESG. If you talk about AI today also, if you don't take care of the G part, AI will also not give you value. So first I would say G is important, and then E and S, depending on the materiality of the company. What is the materiality? For example, it's a people-oriented company like banking or service sector, then it's about S more. And if it's because banks hardly have environmental footprint, right? Unless they are funding oil and gas and other industry where they have Scope 3. But otherwise, service sector does not have that much. However, their S is important. And then manufacturing side, it's E and S, both are important because they are having larger carbon footprint. And depending on the sector, again, S also is important because of labor involved, etc.
Makes sense. Is there given the foundational importance of governance, how do you drive maturity both within at the board level for sure, because obviously the bigger the organization, the more likely you're going to have sophisticated board members. That in Canada, the most popular board designation is ICD, Institute of Corporate Directors. But it's very expensive, right? It's like $20,000 to get certified. So board governance in some cases tends to be lower, and obviously the smaller company, the lower the maturity. So how do you build governance maturity both at the board level and at the organizational level? And then how do you drive clarity between what's the role of the board, what's the role of the CEO, what's the role of management?
Yeah. So that's where the governance structure comes into place. But to answer your first question, how do we drive this is through awareness, and it's through education. Depending on the maturity level of the organization, whether it's a company, as you mentioned, that 2015, 2016, a lot of hype about ESG, a lot of people were doing ESG. And so if an organization has been doing ESG and producing publishing sustainability reports, then I would assume that they have some level of awareness inside, or they're doing it for compliance, or they're doing it for brand building. They have some level of maturity. But let's say if an organization is a small one, or they haven't done ESG before, they haven't produced any kind of sustainability related information, then in that case, we start with awareness. And the awareness, through our consulting assignments, it happens through, first is the board and the C levels. And that's it. Then we go to the mid-level to determine materiality, and then we give them OKRs and action plans so that they can drive it through in the entire organization. So board education is the required solution in case organizations do not understand about ESG, or they haven't started the journey. But in case if the board is matured, sustainability reporting is matured and they have awareness, they've been doing it for compliance, even after that, board education is needed. For example, now we have ISSB as the standard, which is applicable in about 21 jurisdictions. They have made it mandatory, and 40 plus are on their way to become mandatory overall very soon. So when we're talking about this ISSB is about, we both will understand more like about CAs, finance people will understand that it's about integrated reporting. So where you integrate finance with ESG, and annual reports should inform how ESG or climate situation is impacting finance, and how are you investing in climate and ESG related initiatives. So you have to put that information in the normal annual report which company publishes every year. That's what ISSB. It's much more detailed, but overall the concept is this, that you have to integrate it with financial information and publish it for your shareholders or stakeholders. So when ISSB is the new thing, then that's where we need to educate board and C-level again, that hey, ESG is not a cost center. ESG is not one department that you put a chief sustainability officer and then let him work and ask for data and publish a report. It's not about that. It's about how you are running and doing business. And are you considering ESG? You have to not only report, but you have to show the KPIs. You have to show how it is impacting your balance sheet and P&L in terms of carbon pricing. If you don't have that information, you don't have that knowledge how to get that information, it's very difficult to produce such kind of a report.
Agreed. On the report side, and I couldn't agree more that ESG does not sit within one department, and naturally you may have 50, 60 or more metrics within the report that need to be assured on. And some of them would come from people and culture, or would come from the environment or different groups. What are some of the best practices that you've seen companies adopt around ESG or sustainability reporting, being both on the production, but also more importantly, driving the lasting sustainable changes that actually move the metrics?
Yeah, so the first thing, for companies who do it very well, it's very cliche to use this example of Unilever. It's a Unilever initiated in 2010, 10 years sustainability linked plan. So they drove it for 10 years and they did it across their business segments and everywhere. And then they always got ranked top company in terms of sustainability. So when you're talking about best practice, let's say Unilever has a best practice. How did they achieve that? By integrating sustainability or ESG parameters in their business strategies. Yeah. The companies which integrate sustainability or ESG into their normal business strategy, I mean, the usual business strategy, which is done 3 to 5 years, and then annual business plans, which are done every year. If you integrate ESG into that, and then set your objectives, targets, and KPIs based on that, and then produce a report, which comes in the natural course, normal course of business, that's where the best practice is. Let's take the other example, a large company with 20, 25,000 employees, 40, 50,000 suppliers, and then they have a sustainability team, one person with 3, 4 executives floating around Google Sheet to get the information and data for ESG. Where finance person doesn't know where this data will come from, how do I report in the data? Operations, carbon footprint, okay, they're just moving the numbers, but they are not aware of how these numbers will impact the business overall. And likewise, logistics or any other department, they don't know. Like, we have a client in logistics industry. So they use a lot of packaging for transporting goods from one place to another. Now, if the warehouse department doesn't know that this packaging needs to be put in certain order, or we need to use more of recycled packaging, things are not going to change. Just inputting numbers in the Google Sheet or in any kind of data reporting, ESG reporting software, it will not help the company because you are not doing real things on the ground. And real things on the ground will be done if KPIs are set properly. If KPIs will not be set properly, if it is not integrated in business strategy. And this is a major problem. We have clients, and then clients, they go through the entire cycle, entire steps process that we take them through. They publish their ESG reports, but then they're back to square one because they say that, our employees are not doing what they should be doing. Even after implementing systems and processes, because the change has not happened. And change will happen only when your business strategy will set their KPIs, performance, integrated into that. Without even saying that this is ESG. You don't have to name it, you don't have to label it. So that's one way where the backlash and pushback can be reduced.
For sure. I mean, I come from the world of consulting prior to being in the industry, and doesn't matter what consulting firm you are, they largely have the same variation. It's a pyramid, and at the top you have governance, people, process, technology. That's really the pyramid, and you have to make sure the entire pyramid is in sync and working. You need to have the governance to set the directions or KPIs or metrics or measurements or whatever it is, and then people need to have the tools. They have to have the process and technology to support it. So speaking of technology, can we just double click a little bit around Corpstage? And I know that you guys are a dual focus firm. You focus on consulting clients and helping them with their ESG maturity. But what does Corpstage does? What does it do?
Okay, so the Corpstage platform is an end-to-end operating model for ESG. What you rightly mentioned, it's about the governance, technology, process, and people. So it's like you can consider it also as ERP of ESG, where people come together. You can onboard people, and then they manage their own part of E, S, or G, whichever they can. Like I was talking about, operational person getting the carbon data on the platform. So that's how people get connected. You can invite as many team members as possible on the platform. But the difference between Corpstage and other reporting software, there are tons of ESG reporting softwares.
I know.
And then, when we go out and they say, hey, we are ESG, but they say, there are so many, what's the moat? Well, how are you different?
Go out there, like, we do ESG too, right? Yeah.
Yes, everybody, and So the thing is, on our platform, it's evidence first and then reporting next. So companies, and it's very, very automated in the sense that when you start the platform and you get onboarded, you are given a checklist, and those checklists are optional, not mandatory, but then it gives you guidance on what information you have in your company. You just upload that. You just upload, integrate, connect through Google Drive, SharePoint, or through API, your ERP, whether it's QuickBooks, whether it's Xero, or whether it's SAP for HANA, whichever, or Microsoft Dynamics. So you integrate that, and automatically the data comes on our platform, ESG platform, and it gives you a score of where you stand in terms of completeness, in terms of your evidence-based, and in terms of quality. Quality as well. That, okay, these documents you have, let's say you have a business strategy, you have a governance committee, and you upload the document that you have this, you have last year's carbon footprint report, you just upload those, or you have electricity bills, you just upload those, or you connect those. So our system automatically, with the taxonomies, integrated into the system, automatically identifies, according to ISSB, you are 50% ready. According to GRI, you are 40% ready, and so on. And then automatically action points are created where you can assign a person, okay, this person will do what. Now that is for report preparation. But for report preparation, you need to do real work. So then you can create those as initiators of projects to actually do those works. For example, you don't have a governance committee or sustainability committee. So then you have to allocate that task to somebody who can help in creation of that committee. So that's end to end, and then everything is provenance based. You have fingerprint or hashgraph technology, which is fingerprinting every document. AI does the extraction of the data, but without human governance, without human signing on it, the system doesn't take it inside. It doesn't. So we don't give AI the judgment. We don't give AI the judgment. We give the role of a worker. AI is working for us, but AI is not taking decisions or judgments on behalf of us. So it's not a black box. Our system is very intelligent, but it's not a black box. Everywhere human governance, because that's my thing. I come from the governance background, so I have made sure that at every point governance is considered, so that it becomes auditable, credible, verifiable. And auditors, every point that is considered on the platform is that keeping in mind what auditors will ask. What auditors will ask. And our carbon footprint calculator covers 35 countries across those jurisdictions. Any country, you are from any country, or you'll get emission factors related to that country. Not just, most platforms, they are built on DEFRA, but ours is like, real emission factors from those countries.
Makes sense. And where most companies struggle with is the evidence, like being able to prove whether they do something or don't do something. And so having the information readily available to prove out this, it makes a big difference. The other thing that I have seen is when we were preparing the sustainability reports is the conversation, the liaison with the rating agencies. And a lot of it comes down to show me that you have this, show me that you have, is the policy, how complete is the policy? So it's that evidence-based that where companies.
I would just like to correct that. It's not evidence-based, it's claim-based. So you have collected the info. It's claims-based. So because you're claiming something that this is my ESG, and then auditors come and ask, where's the evidence? And then you collect the evidence. That's a headache, that's a problem. What I am saying is, let's say a small company, a small hotel, a small clinic, they want to show. It's a very, very small entity. That is what I mean to say. If they want to do ESG, whatever they have, because ESG is not to be grown or created, it's in your system. Whatever you have at the moment, you upload that first. You would have electricity bills and water bills to the minimum. Any business would have that. So you don't have to go back and collect those once you report that data. That is where the headache comes. What I'm saying is, bring the evidence first, and that's where your records are generated based on that. So you will not have to run here and there. So it's not claim-based. It's evidence first. That's the difference. And that companies will not have a problem because that's a reality that they have. And if they really want to be credible and if they want to be provable, because auditing is the next, I would say, context or next situation, according to mandatory standards also.
Yeah.
And companies which are not auditing, they are also not getting the premium pricing, because if you know about this regulation or new standard, which is CBAM, Carbon Border Adjustment Mechanism, small suppliers who are exporting to Europe, they have to report on scope 1 and scope 2 of their manufacturing operations. But if they get it audited and verified, they get a better price.
Mm-hmm. I mean, it makes sense. It's kind of...
Yeah.
No, go ahead.
Yeah, that's where the value comes from, auditing, and if you have records which are provable, even in tenders everywhere, rating agencies or tenders, government tenders, it's very easy if you are going by whatever you have, documents first, and then building the records.
Mm-hmm.
That makes it better for companies. Mm-hmm. Yeah.
Makes sense. I'm assuming that where we had it is that, like, when the Sarbanes-Oxley Act of 2002 came in, 2004 to 2007 was bonanza for consulting firms in terms of implementing this. I'm assuming that companies will adopt the same type of framework and adhere to the same level of rigor around ESG when they're producing sustainability data, the same equivalency in terms of having controls of the same level of importance as what you would have over internal controls over financial reporting.
Mm-hmm. Yes, that's true. That's true. So that's what I'm talking about, integrated report, ESG and financial report. So that's where, importance of internal controls, internal audits, proving that has become control centers. This has become more and more important. That's where our work is also growing, in the sense that, we have done lots of training for internal auditors on how to do ESG audits.
Mm-hmm.
Because companies are realizing that there is a need for internal controls related to ESG data. One more thing I wanted to say, that when ESG was like 2015 to 2022 or 2023, that was a period of confusion because ESG was evolving, and then there were lots of standards were introduced, or they were already there, but companies were not clear which one they should do. So let's take UN SDGs. I mean, everybody had to show, all companies had to show how they are, contributing to UN SDGs. Then GRI was voluntary framework, TCFD, and then came TNFD, then SASB. I mean, and then and CDP reporting. I mean, that's where you report your data and you get rated again. So, and EcoWith is another platform. So companies, I mean, when they are reporting and they are thinking, this framework, let me ask this consultant to come and do it. Then another CDP framework. Okay, we still have to do CDP. Let's call in another consultant to do it. So their cost was more because of the standards or the number of frameworks that they were following. But with the software, when you just upload, you don't even have to key in. 95% of the data is connected or uploading on the platform. When you do that, you don't even have to worry about definitions, parameters, principles, KPIs. I mean, what will be required to do CDP reporting or do SASB reporting? You don't have to worry about that because the intelligent system does it all for you.
But is this really so? What my personal experience is with one of the companies, we spent close to $30 million on a data transformation in terms of getting the data ready in order to be usable for ESG reporting. Some metrics like, okay, well, the diversity of the board, easy. You can see this diversity of employees, training, like some data is very easily available, whether it's through your corporate ERP or other learning management systems or whatever. When it comes to like, okay, if emissions reporting, let's say it's Scope 1 emissions, like again, fairly easy. You have monitors and things like that. What is this universally the case that the data is available and you can ingest it, or kind of like typically what I've seen from programs like that is the data is the foundational piece that trips companies. If they have the data, I feel fairly confident they can execute and actually build out the report and assure on it. Where they lack is kind of getting to the data. Thoughts?
Yes. So data is a problem. First of all, there are two problems there. One is that they don't know where the data is coming from or what will be included in ESG data. They may already have lots of things, but they still don't know whether this thing with this particular document, which I already have, will contribute towards ESG. So there's a gap of knowledge there. And the second thing is that, yes, for Scope 3, for example, or waste, I recently, I had one of our potential client is hotel industry. So we were just doing a round of the hotel and understanding, preliminary things about ESG. So about waste, for example, they don't know that they should be weighing the waste what they are throwing out, right? So just a simple procedure. They have everything that they do it 2 times a day and everything, but then they have a weighing machine in the kitchen, but they just have to weigh it. So simple processes would help them to create data, right? So that is one thing. And then related to Scope 3 is a little complicated, and that's where I'm assuming the majority of your costs that you mentioned have gone, is because suppliers are reluctant to provide information, and then it does require a lot of engagement with suppliers. And other like all 15 categories have some way or the other, you have to interact with customers, you have to interact with your suppliers, and that's how you get the data. But then again, I would say if you have a proper technology platform system which can send out questionnaires, or for the activity-based data, you can just send out very simple, with the help of a click, you can send out the questionnaire to your 20,000, 50,000 suppliers. And then, of course, that would require CRM. You would follow up with them to give the data. But then you follow 80-20 rule, that who are the top 20 or, suppliers for you, top 20%. So you get the data from there. Another way to get the Scope 3 data is the spend-based method, which most platforms are now using. They're connecting the ESG platform or ESG modules to the finance modules. And that's where, when supplier is sending you the materials, let's say you're a garment company, if the supplier is sending you textile, you can see how much carbon footprint is there in that. Where it is coming from, how many miles it is coming from, which country it is coming from. So all the invoices are there in the system, and we can actually connect the ERP to bring that data into ESG carbon calculators to get the spend-based method of Scope 3 calculations. Scope 3, of course, are estimated ones, not 100% accurate, but companies do rely on that. But I would say first step is to connect and get the Scope 3 by spend-based, and then you implement supplier-based questionnaires and detailed engagement activities to get the real activity data.
So, Nisha, how do you ensure data quality and data integrity?
So data integrity and data quality, as I said on our platform, is that once you upload the invoice and or any invoice, any system, it comes on the platform, then there is a human confirmation which is there. human confirmation. So a person who is responsible, we follow RACI metrics. So according to the RACI metrics, the person will have a signing authority that yes, now the data has come, I'm signing it. So there is a provenance on that this person signed this particular document or ingested this document at this time, and there's an audit trail related to that. That's how data quality is monitored on the platform, that everything is proven. And everything is confirmed by a human person whose job is at risk if they do not do so, properly. So that's where. And at the source level, the quality of data can be improved if you connect directly HR platform directly to the system. You connect, nowadays we have smart meters, so you connect utility APIs. In Singapore, for example, we have utility APIs, so water, sewerage, electricity, sewage, waste. Everything is coming directly from those IoTs or those platforms. So it's monitored. It's evidence based.
Would you, AI has been an incredible unlock, but would you ever consider taking the training wheels off on the data sets? So if you've trained a data stream, like the data is properly labeled, and would you consider, removing the human from the equation and just let the data flow?
No, I won't do that because no, totally no. If I want my platform to be fully evidence-based, credible, and provenance, then I would not remove the human aspect from there to confirm the data. The governance, as I said, is the priority in every situation. Even if you use AI, if you implement AI, we are seeing a lot of cases of shadow AI, and then how employees are leaking out information through their personal chats. People, to reduce their workload, they're using chat GPTs or Claude or in their office environment, and that's how a lot of data privacy and security issues are happening. If a small company, doesn't take care, people may argue that governance is large companies thing. They set up board, they have committees, etc. But imagine a small scale company, allowing its company to, or even if not allowing, people are using chat GPTs and their own AIs to reduce their workload, just uploading a supplier-based contract on this thing to analyze what are the pricing parameters, etc. Imagine if something goes wrong with the data privacy, the company will become bankrupt on the next day. So governance is very important even for small-scale company. It doesn't come in the form of a committee or board members. It doesn't come in that form. It comes in the form of simple processes and simple supervision, which is required.
Yeah. So to the pundits out there that's continue to view ESG as you put it, as a cost center, as a necessary evil or regulatory requirement, can you make the business case as to where you have seen sustainability actually affect access to capital rather than simply corporate reputation?
Absolutely. And last week I was in Singapore. My topic of presentation in the conference was ESG pays off. ESG does pay. So absolutely, there is a business case for ESG. I said that there are two ways where business can draw value. One is the value creation aspect, where business can have growth, profitability. And people may, the audience would be saying, she's just talking like that. But in case your suppliers today, suppliers are asking for ESG information, government tenders are asking for information, exporters, are required to produce their scope 1, scope 2, at least scope 1, scope 2 data. So you need to start somewhere to talk about ESG. And you also, like it's happened in the past, even without the terminology ESG, the Monsanto, merger and acquisitions failed because of lack of due diligence, that time. So if you don't take care of the S or environment, pesticides, customers, taking care of customer interests, companies have been fined and penalized, and they lost value. So just
Yeah.
taking care of these in the label called ESG is the same thing which we've been doing, which is business is expected to do. So there's nothing new, and that's where the growth and the value comes from. Second thing is resilience. You cannot build resilience and risk management, you cannot do without considering ESG parameters.
Mhm. And on the ESG parameters, are companies measuring too many things? And does this become a bit of an overload in terms of what we're focusing on? Kind of like, how do you differentiate the things that truly matter from the ones that it's nice to have?
Yeah, that's what we call materiality analysis. So companies, and when we say materiality analysis, it should be done at the time of strategy. So and in the first part of the podcast, I mentioned that it's important to integrate ESG strategy with business strategy, right? So when we are coming up with ESG roadmap or ESG strategy, materiality analysis should be done. Now, what is this materiality analysis? Materiality analysis is to identify which factors are affecting our business growth, value, profitability, risk management, which are those, whether these are customers, are our customers satisfied, are our suppliers happy, do we have long-term relationship with our suppliers, are our employees productive or satisfied and happy? So these things, I mean, engaging with different stakeholders would tell us whether we have materiality related, to which business section or business function do we have the materiality. So it's kind of internal and external business environment analysis to identify the risk factors. That's where if the materiality is significant, you can rate it on a scale of 1 to 5. And if it is significant, that should be the priority for the business rather than overloading and trying to, gather data and everything from all the parts and making ESG a cost center. So
Yeah.
That would help in, creating more value rather than ESG as a cost center.
Makes sense. So Nisha, our audience is primarily comprised of investors and founders. So if you are a founder, rather than a big enterprise that has like a 20-person reporting team, small organizations don't have the luxury of big reporting things or chief sustainability officer. What should a company that's, let's say, between $10 and $50 million, what should they be doing around ESG?
Yeah. So I would say they should appoint one champion. I mean, not necessarily hiring a chief sustainability officer. It could be one ESG champion in their organization, and then start with a small meetings, a small committee which meets every month or let's say a quarter, and then start discussing about ESG. So that will be at the awareness level. So first creating through this committee, creating awareness within the organization, and then slowly, gradually integrating business strategy with sustainability mindset. So I will not use the term ESG also. Just having a sustainability mindset and coming up with your routine, normal business strategy and business planning would really help even a small company to do so without incurring a lot of costs in the so-called ESG department or sustainability departments. They don't have to create that. Just one champion, just one nomination is good to start. And then, of course, you can take help of consultants or platforms to drive it further.
Makes sense. What are there gotcha moments? Are there things that companies that they're adopting or going down the path that actually ultimately lead them down the wrong path? And kind of like, what are the things that companies should be mindful of when they're thinking about ESG and sustainability and reporting and just changing the behavior, driving for impact? Kind of like, what is a path that they shouldn't take, but maybe it's a path that other companies have taken, and what is the best path to take?
It's a tough question, or it's a very interesting question to answer also. I've seen companies, as I also mentioned in a couple of minutes before, that the companies, they think that ESG needs to be done from the compliance focused, and they start they're reporting it, and they hire lots of consultants because they don't understand definitions and what is required for compliance. They are also scared of greenwashing, so they engage with consultants and all that. What I've seen is that large companies, particularly, they spend millions of dollars only on the consulting part. So they invite, they spend, and then later, after 2 years or 3 years, they realize, oh, now we don't have any more budgets. It's taking a lot of money. We don't have budgets. So how do we actually implement this? Oh, you paid a lot of money for just coming up with a strategic roadmap. You paid a lot of money to just understand what you need to do to do your gap analysis. And now, when it is a time where you have all the foundation ready and you want the decarb, you should be doing decarbonization. You should be taking real initiatives. You're out of budgets. So that is where wrong practices, I would say. I've seen companies like that. That's where the wrong path, has hurted them a lot. Now, why it is a wrong path? Because it has exhausted their budgets. And what should be the right path? The right path is starting from the board of directors to the C-level, educating and making sure that they understand that ESG is a value creation tool. It's a risk management concept that they should be taking forward. It's not something just for compliance or just for reporting. It is for everyone. It's a mindset that companies, everybody should follow. It's a cross-functional thing. We have to involve everybody. It's a change management. It's transformation thing. It's not one-off thing. Okay, tick mark and done. Compliance and checklists do not save company from falling. Just following that.
Okay.
So they not create value also.
I couldn't agree more. It's a common misunderstood area. You talked about the importance of integrating the ESG strategy with the overall business strategy. A lot of companies struggle with this. A lot of the strategy exercise tends to happen with, obviously, within the corporate strategy groups, if it's a bigger corporation, consultation with the executive team, with the board, but quite often a lot of things get overlooked, and the focus tend to be on the things that they're revenue generating, like what would make the cash register ring and what would keep the cash register ringing, and anything else. It's I don't want to say that it's an afterthought, but it certainly doesn't have the same prominence.
Yes. That's there. But the customer scene is also changing, as I mentioned about the exports at CBAM. I mean, that's where things are changing on the export side. On the other hand, when we look at banking, I mean, the millennials or young youth generation, they are asking for a lot of green financing, sustainable financing. I mean, where are you putting my money? If I'm depositing the money in the bank, where is my money going? And are you funding it, using it for fossil fuels? So, and it's also proven that about companies can charge 7 to 9% more if they are, producing sustainable products and using recycling or any other kind of sustainable practice in their production. So premium pricing is possible. It also reduces waste and brings efficiencies and savings. That also contributes to profitability. But people want to see numbers. I tell my SME clients that give me 6 months. I will show you numbers, how the numbers are coming in. So we don't say, okay, we just come in, we ask data, help you report and put it on your website or help you to do the compliance. We say, okay, we are coming in, you just give us 6 months, we'll show how your business value is created. Simple things, your electricity, water, waste will contribute towards efficiencies. your employees, if they are heard of, if they are taken care of, that will contribute to productivity. This is proven. One of my client companies, we were having materiality workshop, and the company was insisting. The company had green strategy, that they wanted to implement solar panels and do rainwater harvesting, etc. But when we got into workshops with middle-level employees, we saw that employees were not happy about certain things. There were certain parameters. For example, the top management did not engage well. They did not understand what employees want, and then the whole session became about complaints. In that workshop, so what we found that the company has a priority or materiality of reducing the number of accidents, making sure that all the employees are engaged and heard of. This is a very important aspect of leadership. Companies, if they ignore it, they would forget about ESG label as such. Companies will have loss of value, when they are not doing this properly. Yeah.
Okay. I know we're almost at time. I like to close my interviews with a choice of a question. You can choose to answer one or both. But what is the kindest thing anyone has ever done for you, or what is the best advice you have ever received?
Best advice I have ever received. And the second question is, the kindest thing
that anybody has done for you.
Oh, that actually, there's a lot, but I can say, inviting me for this podcast has been the kindest thing, Maxim. So having me here is, I'm very thankful for that. Thank you.
This is the first, actually.
Yeah, that's true. Yeah. But for me, the advice that I've received, the best advice is that we should always explore our own potential. And our potential is hidden inside, and same thing applies for companies also. Just to make cash flow rich, cash is inside the business. It's not outside. Don't look for it outside. The best internal finance comes from working capital. We all know that. The same thing applies. It's a human thing as well. We have all the energy. We know how to get things done. It's only that unlocking our potential will help us to do this. So that's the message, and which drives me, in my career, in my life.
Nisha, it was an absolute pleasure having you on and getting your insights on ESG, sustainability, corporate governance, and how companies should think about adopting this or fostering it.
Honored to be here. Thank you, Maxim. Really honored.
Thank you.
Yeah, thank you.